application for cash flow forecasts. To help us go back to that grid and fill it out, we need a question, a situation to apply to. So let us imagine we have a band, Sessions. They specialise in the tambourine. So, number one, they have receipts of £500 a month. So every month that they go gigging, they make 500 quid in 1 month. And we're going to, for the moment, imagine that 500 quid, it's paid immediately. So the £500 is paid immediately. Also, the other assumption is that Sessions is a brand new business. Brand new business, starting in January, we're saying. Number two, expenditure. So remember, expenditure is the same thing as your cash outflows. It's your costs, effectively, your spending. So they have, Sessions, they have expenditure of £350 a month. And number three, Sessions have decided they're going on holiday for all of March. So the receipts, the cash inflows from their gigging would obviously be zero if they're going on holiday, but their outgoings will still be £350. We will now apply this question to our grid. Now we have looked at the question, we can try and fill out the cash flow forecast. The first thing to note is, we said earlier on, it's a new business, and we can say for this new business that the opening balance is zero. It could be 100, it could be minus 100, but to keep it simple, we're going to say the opening balance is zero. So when the business opened, they had no cash in the bank. Okay, so we saw that the receipts, the money that Sessions will get from doing their gigs, is £500 a month. So we can put £500 in January, we can put £500 in February, and we can put £500 in April. We have to put zero in March because that was when Sessions was taking a very long, month-long holiday. So we put zero in here. Then we can move on to the cash outflow. The cash outflow, the expenditure, the spending, the costs, it came to £350 each month, including the month of March when the holiday was happening. We can just therefore put 350, 350, 350, 350. Let's just change that. Okay, for your net cash flow, remember the formula is receipts minus expenditure equals net cash flow, or it is cash inflows minus cash outflows equals net cash flow. Inflows minus outflows. So 500 minus 350 is 150. Now, if we see here, net cash flow plus your opening balance will equal your balance at the end of the month. So 150 plus 0 is 150. So we put 150 here. That's how much money they will have left at the end of the month. The thing you can do with this is that on January, the last day of January, the closing balance is 150. So therefore, on the first day of the next month, we know the opening balance will be the same. It will be 150. It gets carried over. So you can move that here into the opening balance for February. Next, we carry on with February. So 500 were your receipts, 350 was your expenditure, 500 minus 350 is 150. Put 150 in there. And then we know net cash flow plus opening balance equals closing balance. So 150 plus 150 is 300. 300 goes in here. Closing balance at the end of February was 300. So we move it into the opening balance for March. So therefore, the opening balance for March is 300. And then we take it again, but this is different now for March. Your receipts were 0 because you're on holiday, but you still had to pay your costs of 350. So your net cash flow was minus 350, and it will go in brackets now because it's a negative number. So brackets 350. That's because 0 minus 350 is minus 350, goes in brackets because it's negative. Now we need to calculate the closing balance for March. So we take the net cash flow, that is minus 350, and we add it to your opening balance. So minus 350 plus 300 is minus 50. Minus, so it therefore goes in brackets. So negative 50. Now, to complete this, we simply take that negative 50 to be the opening balance of April. So therefore we put the 50 negative there in brackets. And to finish it off, Sesh is back from holiday now, so 500 receipts minus the 350 gives you 150 again here. And to calculate your closing balance, you would take the net cash flow of 150 plus minus 50, so therefore that equals 100. So 100. And that has completed your cash flow forecast. The thing to note is, when Sesh went on holiday in March, he had a negative closing balance of £50. Therefore, it would make sense that he has to apply a source of finance here, and that source of finance looks like it's short term, because when he comes back from holiday, he's back in the positive for April, and that short term source of finance that would make most sense is probably an overdraft. So in this situation, you've used a cash flow forecast, you've knocked out all the numbers, and you've come to the conclusion that it would make sense to have an overdraft in the month of March. So therefore, maybe in January, you go to the bank and say, please may I have an overdraft because I am going on holiday in March and expect to go negative. I hope that helped with your cash flow forecast.